So hello everyone and welcome to Expand Your Income with Triple Net Lease Retail Investments by Overland Capital. So my name is Michael Holman and I will be your host today. We also have Ken Holman with us today and we'll introduce him shortly. For those who have been on for a while, he is known as the person who plays ABBA music before every single webinar.
That's not good if that's the only thing I'm known for.
Most well known for his love of ABBA music. So just a little bit about Overland Capital. Overland Capital is part of the Overland Group family, which is a fully integrated real estate organization. We've been around for over 30 years now. The goal of Overland Capital is to provide investors with a better investing experience. And we really believe a big part of that is giving people the opportunity to learn about investing in commercial real estate. I mean, we've all heard the phrase invest in what you know, and commercial real estate is absolutely no different. So feel free to ask questions throughout the presentation, and we will do our very best to answer all of those questions at the end. For those who have been to previous webinars, you probably understand that's really probably the most valuable time we spend with people. I mean, we answer all the questions that we possibly can, and you're able to ask us directly. We usually don't shy away from any questions. For anyone who needs help locating that Q&A button, it is at the bottom of your screen. Also, as I mentioned earlier, you will be receiving an emailed copy of this presentation, but you can also view it on our website at overlandcapitalcorp.com and clicking on the education tab. So just a little bit about me. I run the investments and finance divisions of Overland Group. I spend a significant amount of my time working with equity partners and lenders. I'm also a licensed CPA. That being said, you probably don't want me doing your taxes because I have not been into that world for a little bit, but that's my background. As I mentioned earlier, we have Ken Holman with us today. Ken is the president of Overland Group and has over 40 years of experience. We won't, the one question we usually don't answer is how old Ken is. We'll let you guess, but just know 40 years of experience.
I'm not that old. Still feel young.
No comment. Just kidding. I'm going to be in trouble after this. So he has developed over $350 million worth of commercial real estate. He also currently has over 85 million worth of real estate in development right now. He holds just about every top designation you can get in the real estate world. But let me turn it over to Ken to talk just a little bit more about himself.
Hey, thanks, Mike. I appreciate that. I guess as Mike mentioned, I am the senior member of the group, like it or not, but I've really been excited about my career in the business and how it's treated me and my family. So love real estate, top to bottom, and really think that it's probably the best investment out there for my money. So hopefully Mike and I can impart a few things we've learned and a few lessons that we've encountered over the years about investing in retail properties. And so we've had quite a bit of experience in that area. And so we're looking forward to imparting some of the knowledge and wisdom that we have in that arena.
Perfect. So as we get started here, I just want to give you a little bit of background in retail net leases. So according to CBRE, they are a very large real estate organization. Retail net leases, including double net and triple net, had an investment volume of about $2.5 billion in Q1. That's Q1 2020. So for the year ended Q1 2020, so that's the 12 months with ending Q1 2020, investment volume was a whopping $17.9 billion. So that's a huge number. And something interesting about those investments, and this is the craziest part, is that a vast majority were investments by private investors. That is very unusual. Private investors invested more than institutional investors and REITs in this asset class. I mean, generally your institutions and REITs, they have unlimited money and they invest tons and tons and tons. You don't see that all that often. So this is an unusual characteristic of this asset class.
I think our presentation, Mike, should help out a lot with telling people why private investors like this space so much.
I mean, I think you're exactly right. I mean, and you find that more people are flocking toward retail net investments. And while I, openly admit they're not the sexiest of all real estate investments, they tend to be extremely reliable, though. I mean, if you have the right tenants, your investment really can even withstand recessions and pandemics. So, I mean, a little lights around that. In fact, we're creating a portfolio investment of these type of investments. And of the 9 tenants that are going to be in that portfolio, only one tenant asked for 1 month of rent deferment. That's across the entire pandemic that's been happening. Everybody's been hearing about retailers and struggles that have been going on. That's pretty amazing. And really, what's even more amazing, we developed all of these assets during the Great Recession. So, interested? Good, because Ken is going to go into the nuts and bolts of why private investors love these investments.
Mike, you mentioned this isn't the sexiest investment, but you do know that the lingerie business is part of retail investing, right? So,
I don't even know what to say to that one. We're just going to leave it at that, everyone.
That's probably a good thing. But, many people don't realize how extensive retail investing really is. The buildings leased to many of the Fortune 500 companies are actually investor-owned properties. And they include both large and small retailers, the big box retailers for, like Walmart, Home Depot, Costco, Target, many others. Most of those buildings are owned by investors. And then there's a host of smaller retail buildings that are also leased to retailers, like companies like 7-Eleven and Dollar Tree and Family Dollar and Ace Hardware, CVS and Walgreens pharmacies. And virtually every grocery store and gas station is probably owned by an investor or an investor group. Something that restaurants should be considered part of the retail group, but generally they're lumped in with food, beverage, and hospitality, which differentiates them a little bit. But our focus today is going to be on smaller retail buildings like the dollar stores and the small neighborhood retail strip centers. We think that's where a lot of opportunities are for investor groups. And some ask, what's a triple net lease? You'll see on there that I say net, 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 that's a terminology that's used quite often in these types of properties. But triple net lease is, where the tenant itself, not the landlord, is paying all of the expenses on the property. That includes things like the property taxes, the property insurance, all the maintenance costs. That's a true triple net lease. And a landlord or a lessor, they pay nothing. And so they also generally have a little lower rent because the obligation is always put on the tenant instead of the landlord. So besides triple net leases, there are double net leases and single net leases, and many people are less familiar with these terms. A double net lease requires that the tenant pay the property taxes and the insurance, but generally not all the maintenance costs. For example, we own a Dollar Tree, in fact, more than one, but the Dollar Trees that we own, they're triple net leases, where Dollar Tree pays all the costs to maintain the building. They even pay a CAM cost which stands for common area maintenance, when there's more than one tenant in the property. But however, we also own Family Dollar stores, several of them, and they are double net leases. Family Dollar pays the property taxes, they pay the insurance, and they cover some of the maintenance costs, particularly on the interior of the building, but they don't cover the exterior costs like parking lot repair or roof repair, things like that. So that's what differentiates a double net lease from a triple net lease.
Thanks,
Let me
Ken.
turn it over to you, Mike, to talk about the changing retail landscape a little bit.
Yeah, absolutely. Thank you for that. So if you've seen our other webinars, you know that we usually don't hold back any punches when it comes to real estate investing. We want investors to invest in projects that they understand not only all of the benefits, but all of the risks as well. That being said, in our opinion, net leases do have way more good than bad, but we are going to get into the good, the bad, and the ugly. And we are going to start with the ugly. As we always do, we're going to show you the darker side of these investments. That way you have all of the information when making investment decisions. So getting into this, really the one and only ugly about retail net lease investments is the relatively lower returns compared to other asset classes. While you can reasonably expect 15% plus on, say, self-storage and multifamily, returns on these investments are usually high single digits to low double digits. To put numbers on that, you can expect somewhere between a 7% and 12% return in general. If someone tried to sell me on higher returns than those, I would have some serious questions about their assumptions. That being said, there are some exceptions. So specifically, if you're doing a development or redevelopment of one of these properties, or you're buying a vacant building and trying to lease that building up with a new tenant, those are really about the only scenarios in which you can reasonably expect higher returns than that, 7 to 12%, maybe 13% range. Now on to the bad. So we got the worst out of the way. Starting with vacancy risk. I mean, this is the biggest concern for most investors. Occasionally, tenants don't do as well as expected and move. Many investors in this scenario are left wondering, what now? This can sometimes lead to fire sales on buildings, which end up giving investors bad taste in their mouth. Really, there is a good way to mitigate this. You can mitigate this by investing in a portfolio of properties, but vacancy risk is probably the biggest concern and the biggest bad of these investments. Next, depending on your tenant, these stores can get very specialized. It can be difficult and expensive if you have a mechanic shop, for example, that moves out. That can leave you feeling limited to only other mechanic shops as tenants, or spending a lot of money and time renovating, if that's even possible.
Hey, Mike.
Yeah.
I did notice that on this, we've introduced a new term we've never used before. We need to maybe define what a building is. Or that's a bidling, right?
A bidling?
Yeah, if you look at that slide, it says specialized bidlings.
Okay. All right. I'm impressed you even catch that. I apologize, everyone. Ken has called me out on my PowerPoint skills. I went to school for accounting. I have a master's degree in accounting. I am not an English major, everybody. If you haven't gathered that already. Bidling. I love it. That's hilarious. Had me all concerned for a second. Okay, moving on from specialized buildings, because tenants, they take on really all the operational risk in retail net investment, which means that they also receive the upside from potentially amazing sales. So as an investor in a retail net lease property, you're going to get your rent, maybe some CAM fees, and that's about it. So really the point that I'm trying to make here is, say on a apartment, if rents all of a sudden were going up 50%, you would get the upside of that huge increase in 50% increase in rents. Versus if you have a net lease property to Family Dollar, it doesn't matter if Family Dollar sells $2 million worth of merchandise or $20 million worth of merchandise, you're going to get the same rent regardless of how Family Dollar does. So that's what I mean really by that set cash flow and the limited upside. Last is location. I mean, we've all heard it a million times, location, location, location. I mean, if you've been in the real estate world, you've heard that phrase probably 1,000 times. And tenants drive investment locations. Trying to build or buy a retail net lease property without doing your research or talking to anybody and just assuming a national credit tenant will come lease it, I mean, that can feel like trying to fit a square peg in a round hole. Do your research, talk to retailers and brokers from the beginning of the process, or your location could really hurt you. Now, let's get on to the good. All right, we've gotten all the bad out of the way. Everybody knows about the risks and the ugly things about these. We're going to go to the good stuff. Passive cash flow is a huge buzzword in real estate investing. And there are no other commercial real estate investments as passive as these bad boys are. The good news about that, usually management fees to manage the investments are significantly less than, say, like a hospitality. Next, and this is probably the biggest draw for private investors, is really the stability of these investments. I mean, these investments provide a level of stability that is unmatched in the commercial real estate world. So Ken mentioned a few potential tenants earlier, and almost all of them are probably names you recognize. And Ken's going to go into more detail on tenant selection, but this is critical. But these retail net investments usually draw and bring in really high quality tenants. And because tenants usually spend a lot of time, money, and effort getting their properties exactly how they want them, they are very reluctant to move. Because of that, you might have heard about some of the requirements tenants have to lease one of these properties. I mean, they plan on staying a very long time, and they do everything they can to ensure that that's what's going to happen, because it's very expensive for them to move. Next good thing, I mean, these investments are about as secure of a real estate investment as you can get. Many of these tenants are national credit tenants with deep pockets who are able to withstand, temporary market changes. And even if you don't have a national credit tenant, these leases tend to put more of the risk on the tenant than on the property owner. Let me turn it over to Ken to talk some about the trends and other things that we see going on in the retail net lease world.
Thanks, Mike. Appreciate that. So some of the lease trends that we're seeing today, which is surprisingly with some of the COVID stuff going on, is we're actually seeing in some types of properties, demand is exceeding the supply. And we found that retail establishments now are beginning to diversify. They're working on improving their buying experience. And I'll explain that in just a minute, but they're adapting to new levels of service and security. They're also improving their data collection efforts so they can compete more favorably with some of the online retailers that are coming on. Many of you may ask about COVID-19 and what effect that's had on the major side. Why don't I turn it over to you, Mike, to talk about that a little bit?
I mean, that's fine. You guys might be sick of it by now, all right? But I mean, you can't have a conversation about investing in today's world without at least acknowledging COVID. I mean, really, COVID-19 has had a major effect on retailers, especially in the hospitality, movie, and entertainment industry. It's also affected a lot of restaurants and retailers, especially in the shopping malls. Some of those shopping malls have been forced to close. And the retailers really who have flourished, though, during the pandemic have been the big box discount retailers, many of the dollar stores. And even during this period of economic shutdown, most of the well-known retailers have continued to pay their lease obligations, really making them an excellent choice when the economy slows down.
They are an excellent choice. It's been interesting to see how Amazon has affected the retail business a little bit, but Amazon obviously is an e-commerce retailer. There's others out there like it, but they've had a dramatic effect on certain aspects of the retail industry. Many of you can remember stores like Borders Books and others that brick and mortar stores that have really struggled that because Amazon has been able to get into their space and market to their clients. But Amazon accounts for about 50% of all e-commerce sales and about 5% of all retail sales. They're out there that you see their trucks, and it kind of gives you the impression that they're taking over the retail industry, and they are in certain aspects, but other aspects they're not having much of an impact. And so they may affect 5% of the retail sales, but that's about it. And since the
Okay,
coronavirus,
Ken,
it
can I
might
jump
be
in
a
right
little
here?
higher. What? Yes, sure.
Can I jump in right here? I just got
Yeah.
a question that I think probably most people are wondering, right? I mean, so there is this Amazon effect. We understand that it's real, and that needs to be acknowledged.
Yes.
Uh, in your opinion, I mean, what is that doing to retail? Do you feel like retailers are adapting? I mean, with this, should we all just be running for the hills from retail? I mean, what is your idea and your thoughts surrounding this?
You know, some of the certain types of retailers obviously have been impacted. Book dealers, uh, you name it. Things where it's easy to get on the internet, select a product, and in a day you receive it, especially during these times when we're all dealing with lockdown issues and stuff like that. But so, yes, it's had a major impact on those types of properties. And yet there's point of sale properties like the discount stores, which have not been significantly affected by Amazon or the other e-commerce retailers. And I think that's mainly because there's still a certain amount of impulse buying that's out there. Not everybody is glued to their computer and is planning on buying everything online. Other people are just looking for an opportunity to get out of the house and go buy something. And so those retailers are really a little bit impervious to the e-commerce group.
Okay, so just to kind of recap on that, I mean, just so that makes sense for me and everybody else, what it sounds like is an acknowledgement that the Amazon effect is real, right? I mean, e-commerce is becoming more and
Yes, it
more a
is.
thing. But I think what you're saying is that means that tenant selection, which I know you're planning on getting into later, but
Right.
I mean, just the emphasis that tenant selection is just that much more important,
Yeah, it
right?
is important.
Okay,
And
no,
I
that
will
makes
get
sense.
into it a little bit later on what that really, what impact that has on certain types of retail properties.
Yeah, no, thank you. I appreciate that.
Sure. So we've discussed the Amazon effect in quite a bit of detail. So let's talk a little bit about why people love double net and triple net leases. Uh, there's a number of reasons I think for this, but especially these double net and triple net leases are mainly with credit worthy tenants. So when you've got a good tenant leasing from you, there aren't many headaches. That's that's wonderful. And the tenant sends basically a check to you every month, rain or shine. That's a really good experience for most investors, especially if they're a little risk averse, and they especially love these types of investments because they just keep throwing off the cash flow month after month, regardless of what the economic conditions are, because uh, they don't earn any money if their doors aren't open. So there's usually a trade-off between the credit quality of a tenant and the amount of rent that you can charge. The better the tenant quality, the lower the rent you can expect to achieve. So in multi-tenant properties, you should attempt to strike a balance between high quality tenants who pay a lower rent and higher rent paying tenants who may be a little bit riskier tenant to have in your property, but they're likely going to pay a higher amount each month. So in single tenant properties, as Mike mentioned, you really need to look for high quality tenants because you don't want to have the risk of having your building sit vacant very long. In these single tenant properties, we always look for national credit tenants. And sometimes that word isn't, that phrase isn't well defined, but that means that they have a high investment grade rating and it's based on their size and their financial strength. The word investment grade simply means a national credit rating from a credit rating agency like Standard & Poor's or Moody's or Fitch, where they've given them a really high credit rating because they're perceived to have extremely low risk of default. Stores like Walgreens, Dollar Tree, Family Dollar, Dollar General, AutoZone, they all fit into this category. And most of them are Fortune 500 companies, by the way. Well, these companies tend to dominate their market and have a high market share. Even the online e-commerce companies have had difficulty competing with these companies in their space, often because they deal with customers. They, as I mentioned, want to buy the product now. They don't want to wait for 24 or 48 hours to receive the product online. So they want the convenience of picking it up and doing it immediately. So even companies like Walmart, they don't tend to try and get into the Family Dollar or Dollar Tree space because those guys have really taken control of that part of the market. But so you value these properties much like you value other commercial income producing properties, except there are some distinctions. If you have a single tenant building with a triple net tenant, if the lease is long-term, 5 to 10 years, somewhere in that range, then most brokers capitalize the annual lease revenue. And appraisers take a little bit different approach. They may throw in a vacancy rate in their appraisal report, but for most pricing purposes, most brokers ignore vacancy on a long-term leased property, and they price a property based on primarily the lease revenue. Now, if the tenant's a double net lease tenant, you have to price in a replacement reserve because you are going to incur some operating expenses and some replacement reserve issues. And so those have to be capitalized into the income. And often brokers will price a double net tenant the same way a triple net tenant is priced. You have to be careful with that because you'll see that if you're going on CoStar and looking at properties, a lot of times they just ignore whether you're a double net or a triple net tenant, and they actually price them the same way. And you can get yourself into a little bit of trouble by doing that. So don't make that mistake. You have to factor in the operating expenses that the landlord is obligated to pay when you're looking at a double net lease property. There is another interesting twist when calculating the return on these investments for double net and triple net deals. You have to factor in when you're getting the annual rent escalations or whether you're even getting them. You know, you'll rent a Dollar Tree and it'll rent for 10 years with a level lease payment for that entire period of time. And or you may have a tenant that's got options that every 5 years then they renew and increase the rent. But that has an impact on how you look at the appreciation and the value of the asset. During that level period, it kind of, the appreciation doesn't go up. Then you get a nice bump in the lease rate, and that's when the appreciation occurs. So you ought to look when you're investing in these type of properties a little bit about the timing of when the leases come due.
Yeah, let me jump in here and just kind of mention one thing with that. I mean, I think a lot of times when we're talking to investors about this, right? Usually most people are familiar with say homes, right? And in a home in general, it's all based on what are the other homes around you selling for, and
Right.
that's how things get priced. Well, especially with commercial properties, and especially with these net lease properties, it's all income based. Right?
Yeah.
So I think this graph shows it perfectly. If your revenue and income on this property isn't changing, unless cap rates change, and you hit this right on the head, Ken, then your
Yeah.
value is staying exactly the same. It doesn't, I mean, it doesn't matter. I mean, generally, yeah, you might have some inflation, things like that, but for the most part, if your income is the same, your value is going to stay the same.
Something that could affect that, Mike, a little bit is if you have a tenant where you can do annual rent escalations.
Yeah.
And they base those on different indices, but like the consumer price index and stuff like that. But if you can get an annual increase of 3% a year, then you can see a more steady appreciation in the value of the asset. Otherwise, it takes this stepped up approach that most people don't factor in.
Yeah, no, I just wanted to, you're exactly right. I just wanted to make sure that was crystal clear for everybody watching, right? I mean, that's why you're seeing this graph in this stepped up way. And people, like I said, I've gotten so many conversations about people who try and compare this to a home.
Yeah.
And it's just not the same, right? I mean, nobody in the commercial world is valuing this based on,
Yeah.
what the Dollar Tree down the street did. It's all based on the amount of money you're getting.
Yeah. Everything's income driven. So that's how these things appreciate in value. So I've noticed that there are basically two approaches to buying these types of properties because they're compared, they're viewed as a safe investment. And so most investors will look at them from either a debt-free standpoint, where there's no loan on the property and they just pay cash for it. We see some 1031 investors that do this. We developed a self-storage project in a town called Woods Cross, Utah, and the owner of that property the seller, decided he wanted to do a 1031 exchange, and I could not convince him to stay into our deal because I thought it was really a good opportunity for him. But he chose to do a 1031 investment and put all the money. He got about $1.5 million, and he went out and bought uh, a discount retail store just like this because he said, I don't want to have to worry about any issues. I don't want any debt on the property. I just want to be able to clip coupons. I want to go off to my home in Puerto Vallarta and Mexico and just hang out there for months and let them send me the rent checks. So he did a debt-free deal. A lot of others are conservative leverage.
Let
You
me
don't
just
see.
say that self-storage is doing excellent right now, and not that I fault that man for going into another investment. To each their own, but that investment is renting up like a wildfire. So that being said, sorry I had to throw it in and say that.
Yeah, well,
On.
I've got to say this too. He called me afterwards, and he didn't say anything like, I made a mistake. I should have invested in that property, because I think he's pretty happy with his discount store investment. But he said, Ken, this is a slam dunk deal. He said, this is the best project I've seen. And he says, you guys have created a real winner here. And so I was really pleased with the positive accolades that he gave about the deal that we had done. And yes, it's that project is on fire. I'm really excited about it. So anyway, that being said,
Sorry.
back to the leverage side of the table. These things don't get over leveraged, most of them. You look at these assets similar to you would bonds rather than like growth stocks. Bonds, you expect to have a low return like 2% yield or something like that. But you do that because a part of your portfolio you want to diversify into risk-free assets. And this discount area, this double and triple net area, are about as safe an investment that you can get. And the cash returns, frankly, are 2 to 3 times greater than you can get in the bond market. Well, so typically, and I don't want to get into the weeds here too much on capitalization rates, but uh, you basically take the gross revenue in a typical commercial property, income producing property scenario. You take the gross revenue, you subtract the vacancy, the operating expenses to come up with net operating income, and then you divide that number by the value of the asset to get what's called a cap rate. And that's just a percentage. And basically what it's saying is if you have this much income coming in without any debt and you have uh, this asset that you're going to get, that you're going to buy, you can expect this kind of return. That's basically what a cap rate is. Well, with most triple net retailers, you don't divide by the net operating income per se that you do on others. You usually divide that by the gross income. And that's the way I've seen most of these valued, because all of the operating expenses, you have no vacancy, you have no operating expenses. So, so it's a reasonable expectation to divide it by the gross income. However, that's a little aggressive. As I mentioned, most appraisers won't do that. They'll throw in a vacancy rate or something, but the better the investment grade of the tenant, the lower the cap rate. So for a company like Walgreens, which is everybody's darling investment in this space, if you're willing to accept the returns, the cap rates run around 5%. And for a Dollar Trees that are triple net leased properties, you can expect maybe a 6% overall return. And then you get into the Family Dollars and some of the others that are like double net leases. Those returns run around 7% plus or minus in that range. So you just have to realize that determine the value that you basically can divide the annual lease revenue by the applicable cap rate. And so a quick example, if you had an annual lease revenue on a property of $84,000 a year and a cap rate of 6%, your value would basically be $1.4 million. That's taking the 84,000 divided by 6%. Pretty easy number, and that's how these things are kind of looked at and valued. So Mike mentioned a little earlier that location is a big factor. Like every other real estate investment, location does play a key role in determining the long-term success of the project. But I just wanted to mention you have a benefit here, because if you're dealing with a national credit tenant, those guys come in, they look at the market, they look at the project, they look at the location, and they will not go in and invest in a project that they feel is not well located. So you can have some confidence in knowing that if you're getting into one of these properties, that that it's been looked at thoroughly by a national credit tenant and they put their blessing on the location. Then there's a little bit of an interesting dichotomy when it comes to the size of the markets that you want to invest in. I ran across one investor that buys nothing but these dollar stores, and he would not go outside a large primary or secondary market. He wouldn't invest in some of the smaller markets. And we see that there are investors that want to pay a higher cap rate for purchasing a property in a smaller market. That's understandable because you think that there's a little bit more risk in buying in smaller markets. But that basically means if you're paying a higher cap rate, you're expecting that the value is lower, the purchase price is lower. And I want to tell you that often the opposite is true. If you're in a smaller market with little or no competition, the likelihood that these triple net tenants will exercise their option to renew the lease is really high. And that gives you an advantage when it comes to buying properties in smaller markets. So I just want to say you shouldn't shy away from smaller markets. They sometimes give you the best opportunity. So our strategy for buying these properties is pretty simple. We look for the best quality tenant in the best location where we think that we have an opportunity to either improve the value by buying at a higher cap rate, or by ultimately, when we sell, we want to sell at a lower cap rate. Now, what that means is a lower cap rate translates into a higher value. So it depends on whether you're a seller or a buyer where you want the cap rates to be. But from an investor perspective, it's always nice to have a good exit strategy. And these are pretty easy in terms of exit strategy. Since there's a lot of demand for double net and triple net investments, they're usually easy to market and sell these properties and achieve a reasonable return. Obviously, it depends on what the timing is, so that's pretty important in these types of transactions.
Why do you say that the timing is important, Ken? What does that have to do with when you exit an investment?
So most people don't see how these things work very well, but say you have a property that has a 10-year lease, like a Family Dollar store, with 5 options to renew for 5 years. So that the life of that whole investment could be 35 years. Well, as you get close to the end of that 10-year period, you have to evaluate whether or not that national credit tenant is going to renew the lease. And you don't know. And it's difficult to find out what their sales are. So you can't always tell whether or not that store is a performing store or not a performing store. And so I've seen what happens is when you get close to the end of a lease term, that will the cap rates start to climb a little bit. And when those cap rates climb, the value drops, the sale price drops. And depending on your situation, you can get a good deal then. But if you're selling, the best time, the optimal time to sell these things is right when when they've exercised the option to renew the lease. You get a bump in rate, cap rates staying the same, your price just went up. So that's what I mean by timing.
Thanks for that clarification.
Just to give you a little example of a deal that we did, that we're in the process of doing in a market here in Utah. We're gonna syndicate this, so I don't want this to be a sales pitch. I'm just going to give you an example of what we're doing with this property. So this property came up for sale a few years before its lease expired. And so it was selling for a little higher cap rate. I went out and looked at the property, absolutely loved the location. Across the street, they had built a new grocery store, and there was a lot of growth in the area. It was on a street that had 20,000 plus cars a day going by, and this is a prominent site. So I thought, okay, this is going to be a good deal, whether Dollar Tree or Family Dollar or whomever is in this property. If they decide not to exercise their option, okay, we're good with that. So I even called them just before I bought it and said, I'm going to buy this property. If you want out of your lease, I'm willing to let you out of the lease because I think there's an opportunity here for us. Well, as it turned out, they stayed in their lease and then they didn't renew. And I thought it was more management than it was the market, but be that as it may, it didn't matter. So what we're doing is we're taking this 8,000 square foot retail property and we're generating higher than average returns on this thing because we're breaking it into a 4-tenant deal. It's an 8,000 square foot deal. We're dividing it into 4 2,000 square foot bays. We've got our first lease. Family Dollar was paying 11.5 a foot as our lease rate, and I got my first tenant that is about ready to sign up. We've agreed to all the terms. It's a dentist, and I'm way excited about what's going on with this property because I think I'm going to get tenants in there somewhere between 15 and 20 bucks a foot. And not all of them are going to be national credit tenants, but dentists are usually a pretty good bet. And I think we'll have to go through the brain damage of a 6-month renovation process. But I think we're going to be able to take this deal, and it's valued at roughly 1.3 million as it sits. We paid $1.2 million something for it, but I think this thing's going to go up close to $1.8 million once we finish the renovation. Could even go higher. So I think we're going to wind up with about a 40% increase in value, and I consider that kind of a really great value add play. So sorry to take too much time on that. I didn't mean to get into all of that, but
You're good. So, if this is something you're interested in, right, we want to give you an opportunity to act. That's really the point of everything that we do. I want you to act on your real estate knowledge and really start making money for yourself. So let me give you one other investment opportunity that's coming up. All right. And this one's really down the fairway. So the second investment opportunity is a portfolio of 8 properties across the Midwest. These are almost entirely discount stores who have done extremely well through COVID. So we're calling this our recession-resistant portfolio. And returns for this investment will likely be 10 to 12% IRR. This is a great opportunity to invest in a portfolio that has similar returns to a single asset investment, but significantly less risk. This investment will be available in the next 2 to 3 weeks.
So and we really do know this. We really do know these properties that are going in here because we built them, we negotiated the leases, and we've operated them. So we know how good they've been performing.
Yeah, and so really just to kind of wrap things up on this all, I mean, as you can see, there are so many good things about these investments. And if you're serious about building a real estate investment portfolio, in our opinion, it is a very, very good idea to have these in the mix. They complement other real estate investments extremely well. And that's it, folks. So please make sure you take the poll that pops up on your screens, as this helps us to get to know you a little better. We're also going to go ahead and get the Q&A started as well. So everyone, feel free. We answered one question before. Generally, it does take a few minutes for questions to start rolling in. If you want to make this our first webinar with no questions asked, feel free to do so. We won't be mad, but know that we are willing and able to answer them. So that North Salt Lake store, Ken, I was just thinking about that. What's the grocery store that went in across the street from there?
It was I think they're out of Boise, Idaho. I'm not sure, but it's Lee's Market is what it's called. And
Oh, okay.
they're similar to Harmon's. If you're familiar with the Utah market, Harmon's is kind of a upscale grocery store that almost feels a little boutique-ish. You know, they do specialty cheeses, they do different things, but this Lee's Market is a great addition to the area, and they've also built some additional retail space that ties into the Lee's Market. But that space is leasing for about $30 a foot. And
Oh,
I'm
wow,
in
that's
across
awesome.
the street. I'm in across the street at $15 a foot, and think that's going to be a good deal. So I can
This
go
is
anywhere
on,
from 15 to 20 and still be in pretty good shape there.
yeah. Oh, this project's on Redwood Road, correct?
Yes, it's right
Oh,
on
yeah.
Redwood Road in North
Yeah.
Salt Lake, and
Redwood Road's awesome.
yeah, and there's a ton of new residential development going on in that market. So
Yeah, that's fantastic.
it's a good area. I've had quite a bit of interest from prospective tenants, but I want to get the right tenant mix in there to fit with the
Yeah,
dentist. So
cool. No, that's awesome. So once again, feel free to ask your questions. We're going to leave this on for probably another minute or two before we close this down. So if you do have any questions, now is definitely the time to get those in there. We're more than willing to answer them. Like I said, the only question that I haven't gotten Ken to answer today is what his current age is. So just joking.
hey,
I gotta stop making that joke because I'm gonna get in trouble. I'm gonna get in trouble
you
if I
can
keep
make
making
that
them.
joke as long you can make that joke all you want. I don't care.
Ken will be turning 45 next year, everybody.
Yeah, right. You mean years in the business?
No, that's hilarious. I one of the crazy things about these retail properties, I've had probably at least five um, five brokers calling me just in the last year asking to buy these properties from us, and I always end up having to kind of
I
put them
get
over.
I get one of those a month, Mike.
Yeah,
So,
we get so many trying to get us to buy these properties. So I mean, it's
but
crazy.
so I think there's a lot of interest. That's one of the reasons we're thinking about maybe putting out a retail portfolio
Yeah.
now is because there's enough interest in the market for these type of
Oh yeah.
recession resistant properties that now may not be a bad time to sell a property or to buy a portfolio. So
Yeah. No, exactly. All right. Looks like we got our first question. This is from Anonymous. Uh, are you looking for an investor for this property? So yes, so we do have, as we mentioned, we do have the two investments coming up. So they're two separate investments. One is the North Salt Lake investment off of Redwood Road. That one, we are converting that from a Dollar Tree into those four $2,000 bays. It's a little bit more opportunistic in nature. That's why you have that higher return of 14 to 15% on the IRR. And the second investment option is the portfolio. So retail portfolios, mostly discount stores that will be coming online. Both of those are coming online in the coming weeks. So you look for an email from us regarding the investment presentations for those. We do a webinar similar to this setup. We do a webinar and we go through anything and everything specifically regarding those investments. So a little secret for everybody who's still online, we do give priority access to investments to anybody who's signed up on the investor portal. So generally what we'll do is we'll send out an email to everyone on our investor portal for really a priority webinar where they usually get a day or two to make an investment decision earlier before we send it out to the general public and the entire investor list. That can play a big, that can be really important in some investments. I mean, our last investment was for, we only needed, it was a small one, we needed 850,000. By the time the webinar had ended, we had $1.2 million in commitments. So definitely I'd recommend signing up for that investor portal so that you have the best chance. Really what happens is we just cancel all the other webinars as soon as we get all the commitments needed. We do have another question. How do we sign up to be on the investment portal? Great question. There's two ways. You can go to overlandcapitalcorp.com and from there you can access the investor portal. You can also go to overlandgroupinc.com and get on the investor portal. You will be receiving some emails as well. So you'll receive an email, I think, starting tomorrow. On that email, at the very bottom, it'll say, click here to sign up for the investor portal. That'll just really give you that priority access. So definitely recommend that. If you have any questions or troubles, you can also email us, investors@overlandcorp.com. We can walk you through the process. Okay, so it looks like that's all the questions that we have gotten. We don't want to take up everybody's time too much. Unless I get a last minute one here, we are going to end this presentation. We appreciate everybody coming on. Hope you feel a little more comfortable with retail net leases and those type of investments. They're exciting. They're not sexy, but when everybody else in the entire world is going through COVID and is getting negative returns and you're trucking along at 8 to 10%, you're feeling pretty good about life. So definitely highly recommend having something like this in your portfolio.
Mike, I said they can be sexy, but I probably shouldn't get into that.
Yeah, we're not going to do that. And yes, we will be sending out this presentation. So if you would like a PDF, I did get a comment about a PDF of this presentation. If that's something that you would like, please send an email to investors@overlandcorp.com. We'll get that to you. We generally don't send out PDFs, but please send an email. That will trigger us so that we know to send that to you. Generally, we send a recording of the presentation. But yes, happy to send out a PDF if you would go ahead and send us an email. Okay, with that, we're going to go ahead and end. Thanks everybody for coming. Have a fantastic day. Be safe, be happy out there, and go ahead and start investing in real estate. Find ways to start increasing your income and start taking advantage of this opportunity that you have to get double the returns on what you are in the stock market. So definitely go ahead and get started in that. Ken, any last words?
Yes, real estate investing is really a wonderful thing to get involved with. I've been in it now for 40 plus years, and I've had some horror stories in the stock market, thinking that I could figure that out. But I can say that one thing that has consistently increased my net worth is the real estate investments that I've been in. And being on the other side of that equation, it's really nice now at this time in my life to be able to have those properties and that income to rely on going forward. So
perfect. Great last words. Thanks everyone.
Thanks.
Have a good day.